In 2025, crude oil plummeted by, $12 a barrel?
Yeah, right around $12.
Right, and the housing market, which was just weighed down by high interest rates all year, it dragged chemical margins down an astonishing 80%.
It was a brutal drop.
Exactly. I mean, by all traditional logic, every energy infrastructure company out there should have just taken an absolute beating on their balance sheet.
Oh, without a doubt. They should have been crushed.
And yet, here we are. Enterprise Products Partners, ticker symbol EPD. They just printed a record $2.7 billion quarter.
It's wild. It really is.
So today on Talk Tickers, we are finding out exactly how they pulled that off. Welcome to the show.
Glad to be here. This is a fun one.
Our mission today for this deep dive is, we want to cut through the noise of this Q4 2025 earnings transcript for you, the retail investor listening.
Right, because there's a lot of Wall Street jargon to sift through here.
Oh, tons of it. So we're taking the raw data, looking at the actual story behind those numbers, analyzing management's guidance for the next 2 years, and giving you an opinionated, highly actionable verdict.
Yeah, what you should actually be doing with this stock.
Exactly. So let's just jump right in.
Well, I mean, it is probably one of the most fascinating contradictions we've seen in the midstream sector this entire earnings season.
The contradiction between the macro environment and their actual profits.
Exactly. You have a macroeconomic environment that is honestly actively hostile to energy and chemical margins right now. And yet, EPD's financial performance didn't just survive that downturn.
Right. They actively broke their own historical record.
Yeah. That divergence between commodity price weakness and their infrastructure profitability, that's really the defining narrative of this deep dive.
So let's not waste any time. We need to look straight at the raw headline numbers because honestly, the scale of the cash generation here is staggering.
It's massive.
EPD reported a record $2.7 billion in adjusted EBITDA for the fourth quarter alone.
And just to put that into perspective, that beats their previous Q4 record, which was set back in 2024.
And that was at $2.6 billion, right?
Yeah, exactly, $2.6 billion. So we're looking at sequential record-breaking growth in a falling commodity market.
Which is counterintuitive. And zooming out to the full year of 2025, their adjusted cash flow from operations reached a massive $8.7 billion.
Yeah, and if you look at their full-year adjusted EBITDA, they noted they came in just shy of the $10 billion mark.
Wait, almost $10 billion?
Just shy. I mean, for the retail investor listening to this, the immediate takeaway has to be the resilience of this cash flow engine.
Right.
When you are generating nearly $10 billion of operating profitability before non-cash accounting charges, you just have an incredible amount of financial flexibility.
Yeah, that cash is the lifeblood of their operations and their growth.
And most importantly, their unit holder returns.
Let's translate that massive corporate number down to the per unit level, actually, because EPD operates as a master limited partnership.
An MLP, yeah.
Right. So for you holding the stock, you're looking at net income attributable to common unit holders hitting $1.6 billion for the fourth quarter.
Which is huge.
On a fully diluted basis, that works out to 75 cents per common unit.
And that basically sets the baseline for the distribution. The earning power of the company is fully supporting the yield here.
Exactly, because let's be honest, nobody is holding an energy MLP for speculative tech stock growth.
No, definitely not.
You are holding EPD for the yield. And the distribution announcement in this call is exactly what you want to hear.
They delivered on that front.
They really did. EPD declared a 55-cent per common unit distribution for the fourth quarter. That represents a 2.8% year-over-year increase compared to Q4 of 2024.
But, and this is key, the yield is only as good as the safety of the payout.
Right. Nobody wants a yield trap.
Exactly. That is where investors typically get burned in the energy sector. Chasing a high yield only to see the distribution slashed when the macro environment suddenly turns negative.
Management addressed this head on, didn't they?
They did. They noted that 55-cent distribution results in a payout ratio of 58% of their adjusted cash flow from operations.
Wow. Okay, for a midstream company, a 58% payout ratio is virtually bulletproof.
It's incredibly safe.
Think about the actual mechanics of that. For every single dollar of cash flow that EPD pulls out of its operations, they are sending 58 cents directly to your brokerage account.
Yep.
And they are keeping 42 cents in the corporate treasury. I mean, they aren't stretching their balance sheet to pay you. They have a massive cushion.
And that retained 42 cents is really the strategic weapon of this company.
How so?
Well, it means they do not have to rely entirely on the capital markets to fund their expansion. They can self-fund massive infrastructure pipelines, lines, export terminals, without diluting your ownership.
So they don't have to keep issuing new equity.
Exactly. And crucially, they use that retained cash to execute stock buybacks.
Oh, the shareholder return numbers they reported for 2025 are a complete bonanza. EPD returned a total of $5 billion to equity investors over the course of the year.
$5 billion.
Yeah, and that breaks down to $4.7 billion in cash distributions and another $300 million in unit buybacks.
Which is significant.
Right. And with that activity, they've now utilized about 29% of their authorized $5 billion buyback program.
You know, the historical context management provided around those returns really emphasizes their philosophy.
What do they say?
They highlighted that since their initial public offering back in 1998, they have returned nearly $62 billion to unit holders.
Wait, $62 billion?
$62 billion through distributions and buybacks. They are making a very deliberate point to the market here. They treat unit holder returns as an obligation, not an afterthought.
I look at a business like this, and I don't even see an oil and gas company. I see a massive 50,000-mile, highly efficient toll road system.
That's a great way to think about it.
You, as the investor, are essentially buying a piece of the toll booth. EPD doesn't strictly care what brand of car is driving on their highway, right?
Yeah.
And to a large extent, they don't even care about the Kelley Blue Book value of that car. They just care that the car passes through the booth.
Because they collect a fee every single time.
Exactly. Every time a barrel of product moves through the network, they take that giant bucket of toll money every quarter, keep 42% to build new lanes, and dump the other 58% directly to the investors.
The toll road analogy is functionally how their underlying contracts operate. But, you know, to fully appreciate how robust that toll system is, we have to address the massive economic headwinds they faced in 2025.
The story behind the numbers.
Right, because as you pointed out at the top of the deep dive, the underlying value of the products moving on their system cratered.
Right. Hold on, because this is where the math on the transcript stops making sense to me at first glance.
Okay, let's break it down.
Management admitted that market realities in 2025 were brutal. Crude oil prices averaged $12 a barrel lower than they did in 2024.
Yep.
But it wasn't just crude. They brought up their RGP to PGP spreads.
Yes. The refinery-grade propylene to polymer-grade propylene spreads.
Yeah, exactly. The chemical margins. They noted that those spreads were sitting at 14 cents a pound in the fourth quarter of 2024.
And then what happened?
By the fourth quarter of 2025, those spreads had collapsed to just 3 cents a pound.
3 cents. That is nearly an 80% compression in their margin.
80%. And management pinned this directly on weakness in the housing market, right?
They did. Since propylene is a key building block for things like PVC pipes, vinyl siding, basically raw construction materials.
That makes sense.
It is a textbook example of macroeconomic contagion. The Federal Reserve keeps interest rates elevated, mortgage rates stay high, new residential construction slows down.
And then the demand drops.
Exactly. Suddenly, the demand for the raw chemical inputs plummets, crushing the margin for the infrastructure company processing those chemicals.
But that is exactly my problem with these headline numbers.
What do you mean?
If oil is down $12 a barrel and your chemical margins are compressed to a fraction of their former glory, the bottom line should be tanking.
It normally would.
So how are they hiding an 80% margin drop and still printing a record $2.7 billion in adjusted EBITDA?
Well, they aren't hiding it. They completely re-engineered their exposure to it.
What do you mean re-engineered?
The answer lies in a strategic pivot that management executed over the last 2 years. During the weakness they saw in 2024 and heading into 2025, they aggressively renegotiated their purchase agreements to a fixed fee structure.
Oh, wow.
Yeah, they deliberately built a shield against this exact scenario.
Explain the mechanics of that pivot. Why would a customer agree to take on all the commodity risk and let EPD just collect a fixed fee?
Because in volatile markets, customers often prioritize guaranteed processing capacity over speculative margin hunting.
So they just want a sure thing.
Right. EPD went to their customers and essentially said, we are no longer going to split the upside and downside of these commodity swings with you. We are going to charge you a flat, guaranteed fee to process your product through our facilities.
So they took the volatility completely out of the equation.
Exactly. Management specifically stated on the call that this makes their business largely spread agnostic.
Spread agnostic, meaning they detach their revenue from the price of the commodity itself.
Precisely. They noted that their splitters are now essentially operating on an inert basis.
Inert basis.
Yeah. They were just providing a service fractionation, splitting, transportation for a locked-in rate.
But there has to be a trade-off, right?
There is. The trade-off is that if propylene spreads suddenly rocket up to 20 cents a pound, EPD won't capture that massive upside windfall.
Ah, they sacrifice the ceiling to reinforce the floor.
Exactly. That is brilliant downside protection.
It really is. They looked at a weakening macro environment and decided to lock in guaranteed revenue streams.
And clearly, that fixed fee floor was high enough to offset the loss of the commodity upside.
But a contract is only as good as the volume flowing through it, right?
True.
I mean, if margins are that bad overall in the market, you need massive volume to make up the difference.
And that volume is exactly what drove the record quarter.
I see.
The fixed fee shield protected the margins, but the raw growth came from an aggressive deployment of new assets. The sheer scale of new capacity they brought online in 2025 is what filled the financial holes left by the commodity crash.
Let's break down that new capacity because the scale is wild.
Where do you want to start?
They brought Frac 14 online in mid-October.
Yeah, the new fractionator.
Right. And for those not deep in the energy weeds, a fractionator takes a raw stream of mixed natural gas liquids, the Y grade, and boils it at different temperatures to separate it into distinct usable products like ethane, propane, and butane.
Right, it's a massive industrial facility.
And management noted that Frac 14 is already fully utilized.
Which is just insane. The fact that a brand new, massive industrial fractionator is running full immediately upon opening is a massive indicator of upstream production demand.
The producers just need the capacity that badly.
Exactly. The producers in the Permian are pulling so much volume out of the ground that midstream capacity is spoken for the second the valves open.
They also brought the Neches River Terminal ethane export train online mid-year.
Yeah, and they noted that those two trains are virtually full today as well.
But the crown jewel of this expansion has to be the Bahia natural gas liquid pipeline, which came online in December.
Oh, absolutely. The Bahia pipeline is the perfect case study in EPD's operational execution.
How so?
Management actually took a moment on the call to address the skeptics. They pointed out that naysayers doubted the Bahia project in the beginning.
Really? What were they saying?
People were suggesting it wouldn't hit its volume targets, but management just brushed that off by saying that is to be expected when you're first.
Talk about confidence. And the numbers actually back up the arrogance, too.
They really do.
The Bahia and Chinook integrated system has a capacity of 1.2 million barrels per day. They turned it on in December, and they are already running it at 80% capacity right out of the gate.
Yeah, getting 80% utilization on a 1.2 million barrel pipe within weeks of commissioning is basically unheard of.
It's crazy fast.
It proves that their forecasting models for basin production are incredibly accurate. They aren't building pipelines on a speculative build it and they will come mentality.
No, they already know they're coming.
Exactly. They are building infrastructure to meet desperate, immediate demand. And that ability to handle massive physical volume is exactly how they capitalize on market chaos.
Which brings us to arguably the most fascinating exchange of the entire Q&A session.
Oh, the Waha discussion.
Yes. Michael Blum from Wells Fargo asked a question about Waha natural gas prices and the severe winter weather volatility.
This single exchange perfectly illustrates the mechanical advantage of owning the physical pipes.
Right. So Bloom pointed out that the Waha hub, which is the pricing benchmark for natural gas in West Texas, has been incredibly volatile.
Very volatile. During the fourth quarter, prices at Waha were heavily depressed, frequently dipping into negative territory.
Okay, we should clarify why a commodity price goes negative, because to an outsider, paying someone to take your natural gas sounds absurd.
It does sound crazy, yeah.
But in the Permian Basin, oil is the prize. Natural gas is just a byproduct associated gas that comes up with the oil.
Right.
If you are an upstream producer, you have to get rid of that gas to keep pumping oil. If there isn't enough pipeline capacity to move the gas away, it bottlenecks.
And you can't just flare it off forever.
Exactly. You can't flare it indefinitely due to regulations, so producers literally pay midstream companies to take the gas off their hands just so they can keep their oil wells flowing.
It's wild. So in Q4, EPD was seeing these incredibly low, sometimes negative Waha prices.
But EPD didn't suffer from that, did they?
Not at all. Management explained that they used their massive natural gas transport capacity to capitalize on west to south spreads.
Explain that spread.
Well, they get paid to take the deeply discounted gas in West Texas.
Right.
They put it in their pipe and they physically transport it to markets in the south or east where natural gas actually has a positive value.
They pocket the spread.
Exactly. They get paid on both ends.
That's the baseline arbitrage. But then Bloom asked about January.
The winter freeze.
A major winter freeze hit Texas. Wellheads froze over, production plummeted, demand for heating surged, and Waha natural gas prices violently spiked.
So how does EPD handle the other side of that extreme volatility?
Yeah, what did they do?
When the freeze hit and prices skyrocketed, EPD just flipped their operational script. They didn't just rely on transport anymore. They utilized their massive physical storage assets.
Oh, they had gas saved up.
Exactly. They had already stored the cheap gas they accumulated earlier. When the grid was desperate and prices spiked, they pulled that gas out of storage and sold it into the peak market.
Wow, that is the ultimate flex.
It really is.
As management bluntly put it, we benefit from volatility on both sides. Low prices. They make money getting paid to move it away from the bottleneck. High prices. They make money selling it out of their storage cavern.
They essentially monetize the physical chaos of the energy grid.
And that monetization isn't just restricted to domestic bottlenecks either.
No, the next major theme of this transcript is the sheer scale of their global reach.
Management spent a significant portion of the call detailing what they refer to as their sticky relationships in international markets.
The aggregate volume metrics they shared are hard to even comprehend. EPD moves over 14 million barrels per day of oil equivalent through that 50,000-mile network.
14 million a day.
Yeah, but domestic movement is only half the story here. Their export dominance is accelerating at a really rapid pace.
Let's look at the marine loading data they provided for 2025. EPD loaded between 350 and 360 million barrels of product across 744 ships over the course of the year.
744 ships. That is a massive logistical undertaking, coordinating hundreds of specialized vessels to move American hydrocarbons to global markets.
And they explicitly stated this is just the beginning.
Okay.
They are completing phase 2 of the Neches River Terminal and executing an LPG expansion on the Houston Ship Channel. By next year, they expect to export nearly 1.5 million barrels a day of natural gas liquids.
Wow.
That translates to loading over $550 million worth of product onto ships on an annual basis.
But what is critical for investors to understand is how they secure the demand for those ships.
Right, because they don't just hope someone shows up to buy it.
Exactly. This isn't a spot market business where you just hope a buyer shows up at the dock.
Yeah.
This is a business built on long-term offtake agreements.
Yeah.
And those agreements require intense relationship building.
The human element of this transcript was surprisingly prominent.
Very prominent.
You might think a $60 billion infrastructure giant just relies on algorithmic trading or email contracts, but management went out of their way to detail their physical, boots-on-the-ground travel schedule.
They framed it with a brief history lesson, actually, pointing out that their international relationships aren't new. They noted they've been doing international business since 1983 with their first import terminal.
Okay.
And they successfully flipped the model to exporting in 1999. Many of their international customers have been doing business with EPD for over 20 years.
Management made a very simple point. They know us. They know how we behave. They like how we operate.
Yeah, trust is everything.
And to maintain that trust, the executive team practically lives on airplanes. They literally listed out the itineraries on the call.
I remember that.
Jim Teague spent the holidays in Thailand meeting with 3 large petrochemical companies. Cristiano was in Europe. Their crude team was in Asia in October and Europe later in the month.
It's exhausting just listening to it.
Tyler Codd was in Korea and India in November, Europe this month, and is heading back to Asia in March. And Jim Teague noted he'll be in Japan next month to visit export customers.
You know, why spend valuable time on an earnings call reciting travel itineraries?
All right, why do investors care?
Because for you, the retail investor holding the stock for yield, that travel schedule is the security blanket for your dividend.
That makes sense.
In global commodities, billion-dollar, decade-long contracts aren't signed purely on price. They're built on trust, reliability, and face-to-face accountability.
Yeah.
When European petrochemical plants are starved for cheap feedstock or Asian manufacturing sectors need reliable ethane, EPD is physically in the room, proving they're the most reliable supplier on Earth. They're locking in the demand that keeps your toll road busy.
That perfectly transitions us into the forward-looking aspect of this deep dive. The 2025 numbers were a record, the fixed-fee contracts protected the downside, and the global relationships are securing the volume.
But the stock market is a forwarded pricing mechanism.
Right. We need to analyze management's guidance for 2026 and their massive projections for 2027.
Yeah, the guidance section of the transcript requires some careful parsing, starting with their capital expenditures, or CapEx.
Okay, laid it out.
Management announced that their 2026 growth capital expenditures are expected to range between $2.5 billion and $2.9 billion.
Stop right there.
It's a big number.
For an investor looking for cash returns, seeing a company project nearly $3 billion of capital spend in a single year can induce a little sticker shock.
Absolutely.
That is a massive amount of cash going out the door to build new pipes and terminals instead of flowing into buybacks or distributions.
It is a massive gross number, but this is why you have to read the fine print of the transcript. Management immediately clarified that this gross spend is heavily offset by structural partnerships.
Oh, right.
Specifically, they apply approximately $600 million in asset sale proceeds that they have already received earlier this year.
That $600 million is a very specific payment. They noted this represents the final installment from ExxonMobil regarding the sale of an interest in the Bahia pipeline.
Exactly. EPD essentially sold a piece of the construction cost to a partner. So when you take that 2.5 to 2.9 billion gross capex range and you subtract the 600 million Exxon cash injection,
the net spend for 2026 drops to a much more digestible range of 1.9 billion to 2.3 billion.
Right. And they also broke out sustaining capex.
For those unfamiliar, sustaining capex is the baseline cost just to maintain the current network, fixing valves, replacing old pipe, keeping the existing toll roads safe and operational.
Exactly. They projected sustaining capex at about $580 million, which includes an $80 million turnaround project for their octane enhancement facility.
So they have a very clearly designed, fully funded plan for maintaining their current assets and building out their growth pipeline.
Yeah, but the critical question for the investor is the math that follows.
Right. What happens to the cash that is left over after all operations are funded, all capex is paid, and all unit holder distributions are distributed?
That is the discretionary free cash flow. And management put a hard number on it.
They did.
They expect discretionary free cash flow to be in the $1 billion area for 2026.
$1 billion of pure unallocated cash. What is the strategy for deploying that capital?
The strategy is highly disciplined, and it's split into two distinct buckets. Management expects to allocate roughly 50 to 60% of that $1 billion directly toward share buybacks.
Okay, and the rest?
The remaining 40 to 50% will be directed toward retiring debt on the balance sheet.
During the Q&A, Jeremy Tonet from JP Morgan pressed them specifically on the buyback mechanics.
Yeah, because it's one thing to say you'll buy back stock. It's another to actually execute it effectively.
Right.
Management's response was very clear. With that $1 billion in free cash flow, investors can model 500 to 600 million being actively deployed to soak up shares.
They specified this will be a combination of opportunistic and programmatic purchases.
Opportunistic meaning if the market throws a tantrum and EPD's unit price dips unfairly, they will step in and buy aggressively.
And programmatic.
That means they will be a steady mechanical buyer day in and day out, constantly shrinking the float.
That is exactly what you want to hear as a long-term holder.
Definitely.
Every day they shrink the float, your slice of the pie gets mathematically larger, which inherently makes the dividends safer because they are paying it out across fewer total shares.
Right. But you mentioned they are using the other half of that cash to retire debt. We need to talk about their balance sheet because this is where the bears will absolutely push back.
You are looking at the consolidated leverage ratio.
Exactly. EPD's stated target for their leverage ratio is 3.0 times, with an acceptable operating range between 2.75 and 3.25 times.
Okay.
But they ended 2025 with a consolidated leverage ratio of 3.3 times.
Oof. They're explicitly above their own target range.
Yeah. For a company that prides itself on conservative balance sheet management, a bloated leverage metric is an immediate red flag.
Why is management comfortable operating outside their stated safety zone?
It is a valid concern. But the transcript offers a very logical mathematical defense of that 3.3 times figure.
What's the defense?
It all comes down to the timing of capital deployment versus revenue generation. EPD recently made massive strategic investments. They debt financed huge, large-scale construction projects like the Bahia pipeline.
Right.
And they took on significant debt to execute a major midstream asset acquisition from Occidental, or Oxy.
Right. They borrowed the money up front. So the total debt number, the numerator in the leverage ratio goes up immediately. The debt is sitting on the balance sheet right now.
Exactly. But the assets they built and acquired are just now turning on or ramping up. The annual adjusted EBITDA generation from these massive investments, the denominator in the ratio, has yet to fully flow down into their trailing 12-month figures.
Ah, so it is a classic timing mismatch.
Exactly.
It's like taking out a mortgage to buy an apartment building. The debt hits your credit report on day one, but it takes a year of collecting rent from the tenants before the income fully reflects on your tax return. The ratio looks artificially bad in the interim.
That is the perfect way to visualize it. Management explicitly guided that they believe their leverage ratio will naturally compress and return to within their target range of 3.0 times by the end of 2026.
Just by letting things run.
Right. They don't need to execute emergency asset sales or slash spending to fix the balance sheet. They simply need to let the new projects run for a full year and let the cash flow hit the denominator.
That fundamentally eases the balance sheet anxiety. And speaking of those massive projects generating future cash flow, we have to spotlight what is arguably the biggest strategic victory buried in this earnings report.
You're talking about the partnership with ExxonMobil.
The UGI on the Bahia natural gas liquid pipeline.
Right. Throughout the transcript, management constantly throws around the acronym UJI. Let's translate that. UJI stands for Undivided Joint Interest.
Explain the mechanics of that, because this isn't just a standard customer contract, is it?
No. An undivided joint interest means that ExxonMobil didn't just sign a paper agreeing to ship their product on EPD's pipeline. Exxon literally bought a physical ownership percentage of the asset itself.
Wow.
They injected capital and became a true equity partner in the physical infrastructure of the pipe.
Connect the dots on why that is so massive for EPD, because ExxonMobil recently executed the acquisition of Pioneer Natural Resources for roughly $60 billion.
Yeah, that's huge.
That acquisition made Exxon the undisputed king of the Permian Basin. They are sitting on decades of drilling inventory. They are going to pull staggering amounts of oil and gas out of West Texas for the next half-century.
And by forming a UGI, Exxon essentially locked themselves into using EPD's pipeline to get all of that product to the Gulf Coast.
It permanently aligns the largest producer in the basin with EPD's infrastructure.
And the cascading knock-on effects are incredible. Because Exxon bought in, EPD immediately committed to expanding the Bahia pipeline to a capacity of 1 million barrels a day.
But it doesn't stop at the pipeline. Management noted that, associated with this UJI, they signed a dozen downstream agreements with Exxon.
A dozen additional agreements.
Think about the physical logistics. Once Exxon's product hits the end of the Bahia pipe at the coast, it doesn't just magically disappear.
No, it has to go somewhere.
It needs to be processed, it needs to be fractionated, it needs to be stored, and it needs to be loaded onto marine vessels. Exxon signed 12 separate, discrete agreements to utilize EPD's downstream infrastructure.
As Jim Teague stated during the Q&A, we touch Exxon in so many places, I can't count it.
It cements a truly symbiotic relationship with the most powerful energy company on the planet.
It really does. Exxon secures reliable takeaway capacity for their massive Permian volumes, and EPD secures decades of guaranteed volume flowing through every step of their value chain.
And it is this exact pipeline of massive locked-in volume that fuels the most critical forward-looking statement in this entire transcript. We need to talk about the 2027 guidance.
This is the projection that every single analyst on the call zeroed in on.
Understandably.
Management was very deliberate in managing expectations for the near term. They explicitly stated that for 2026, investors should only expect modest growth in adjusted EBITDA and cash flow.
That seems counterintuitive. If they just finished building all this massive infrastructure and Bahia is already 80% full, why are they only projecting modest growth for the current year?
Because of the operational ramp-up period required for massive industrial assets. You don't just flip a switch and instantly realize 100% efficiency.
That makes sense.
Assets like Frac 14, the integration of the Oxy acquisition, and the Neches River second train are either just coming online or will be steadily ramping up throughout 2026.
Yeah.
Tyler Codd explained this dynamic perfectly to an analyst regarding the Neches River train. He noted it will start by loading propane and won't fully shift to its primary purpose, loading mostly ethane until around the end of next year. It takes physical time to optimize these complexes.
But once that optimization is complete.
Exactly. Once that transition year is over, management is officially guiding for a massive step up. They stated they expect in the 10% area step up in adjusted EBITDA and cash flow in 2027 compared to 2026.
Let's put hard math to that percentage. Keith Stanley, an analyst from Wolfe Research, pointed out during the Q&A that a 10% step up on a nearly $10 billion base means EPD expects to grow their EBITDA by roughly $1 billion in a single year.
That's massive.
Stanley correctly noted that would represent the fastest organic growth rate for the company this entire decade.
It is a phenomenal acceleration in profitability. Randy Fowler confirmed the trajectory, listing out the specific dominoes that will fall to create that billion-dollar leap.
What are the dominoes?
By 2027, EPD will recognize a full year of operation from the Delaware processing plant, a full year from the Midland plant, the fully realized synergies from the Oxy acquisition, and all of that massive Exxon volume cascading down the Bahia pipeline into the fractionators and across the marine export docks.
Well,
2027 is essentially the harvest year for all the massive capital seeds they've planted over the last 24 months.
so we have laid out the entire narrative. We unpacked the record $2.7 billion quarter. We analyzed the fixed fee shield that completely insulated them from an 80% crash in chemical margins.
Yep.
We explored their ability to monetize chaos during the winter freeze, and we decoded their roadmap to a $1 billion cash flow jump in 2027. It is time to bring it all together. What is the bottom line verdict on EPD right now?
Is this a bullish or bearish signal for a retail investor?
Exactly.
I am taking a definitively bullish stance on this earnings report, particularly for any investor whose primary goal is safe, growing income.
Make the case. Why are you firmly in the bull camp?
Because Q4 2025 is the ultimate proof of concept for EPD's modern business model.
Okay.
To post record profits in the face of a $12 drop in crude oil and an absolute collapse in chemical margins proves that their strategy of pivoting to fixed fee contracts works flawlessly.
Yeah.
They have successfully decoupled their dividend from the wild cyclical volatility of the energy sector, while simultaneously growing their dominance in global natural gas liquid exports.
Let's make this highly actionable for the listener. If you already hold EPD stock in your portfolio, your investment thesis is completely intact and heavily reinforced by this data.
Yep, hold tight.
You are collecting a safe, growing yield. They just bumped the distribution by 2.8%, and it is protected by an incredibly conservative 58% payout ratio. You do not need to lose sleep over the distribution getting cut.
And you have the added tailwind of management taking half of their billion-dollar free cash flow and steadily buying back stock, passively increasing your ownership stake quarter after quarter.
And if you are currently sitting on the sidelines considering initiating a position in the stock,
You have a very clear timeline laid out for you. You're looking at 2026 as a designated transition year. Earnings will grow modestly as these massive infrastructure projects ramp up to full commercial speed.
right?
But you are essentially buying in now to secure your basis and capture the 6% yield before that guided 10% EBITDA explosion hits the market in 2027.
So buy now before the big jump.
Once the Oxy assets, the Neches River expansion, and those massive Exxon UGI volumes hit maximum utilization, the cash flow generation of this company is going to re-rate to an entirely new level.
It is remarkably rare that a management team gives you a roadmap that transparent. The thesis is basically buy now, collect a safe yield, and wait for the $1 billion jump in 2027.
They have engineered an infrastructure machine that seems practically immune to the standard boom and bust cycles of the commodity market.
We covered a massive amount of ground today, from decoding the mechanics of a fixed fee contract to the freezing wellheads of Waha to the petrochemical plants in Thailand driving long-term demand. But before we sign off, I want to leave you with one final provocative thought.
Oh, yeah.
Something for you to mull over that wasn't heavily focused on in the headlines, but represents a massive macro trend.
This ties back to a specific question raised during the Q&A regarding the broader structure of the energy industry right now.
Exactly. An analyst asked management about their appetite for future acquisitions, especially considering the massive wave of mega mergers currently sweeping through the upstream oil and gas sector.
It's a huge wave.
We just talked about Exxon buying Pioneer, but you also have Chevron buying Hess and Diamondback merging with Endeavor. The upstream sector, the companies actually pulling the oil out of the ground, is consolidating at an unprecedented rate.
The EMPs, the exploration and production companies, are shrinking in number but growing massively in scale.
Right. And when asked how this impacts EPD's strategy, Jim Teague gave a very colorful, classic Texas oil man response. He simply said, "I don't see as many girls on the dance floor as there used to be."
It's a folksy metaphor, but it highlights a critical dynamic. The pool of independent players is evaporating.
So here is the lingering question you must consider over the next decade. As these upstream E&Ps consolidate into a handful of massive trillion-dollar behemoths, how does the balance of power shift?
Yeah, if there are only 3 or 4 giant oil producers left controlling the entire Permian Basin, will they eventually throw their weight around and use that localized monopoly leverage to squeeze midstream operators on contract pricing?
Management insists their relationships are too sticky, their export capacity is too valuable, and their infrastructure is too critical to be squeezed.
But for you, the investor, watching the dynamic tension between the mega producers pulling the oil and the pipeliners moving it is the absolute critical macro trend to monitor in this sector.
It is a phenomenal point of tension. EPD owns the vital highway, but the number of trucking companies using it is consolidating. Whoever holds the leverage in that relationship will dictate the margins of the next era of American energy.
It is going to be fascinating to watch unfold.
Well, that is all the time we have for today's analysis. We highly encourage you to keep diving into the data, stress test your own portfolio, and tune in next time for another actionable deep dive. Keep asking the hard questions.